I wanted to make a quick video on Index Universal Life Insurance, or IULs, sometimes called the rich person's Roth IRA, and I'll explain why in just a minute. They've been around for a while. My first job in this business was as a financial advisor with a company called Edward Jones. That's where I learned about them. That was years ago. But for some reason, IULs have gained a lot of popularity lately. Unfortunately, sometimes with extreme popularity, you get misinformation. And you really have to be careful with this product, because if it's structured properly, it's amazing. If it's structured improperly, it is a horrible product that should be avoided. And I'm going to give you two crystal clear examples at the end of this video, end of this lesson, with illustrations, so you know the difference going forward. But right up front, it's important to understand what an IUL is and what it's not. It's not an investment. It should not replace your 401k or Roth IRA, for example. It's simply an insurance contract with two parts. There's a death benefit, of course, and your cash value is linked to a stock market index, typically the S&P 500. But here's the best part. We participate in the upside of the stock market up to a predefined cap or percentage of the S&P's growth in any given year. But if the stock market drops, which is just a normal part of investing, right? You won't make any money that year, but you won't lose any money. So you get the best of both worlds. And why is that important? Well, before I dive in, I want to show you a quick video reminder of why that's important. This video is from around 2008, just a simple reminder of how history can repeat itself and the need to position your portfolio correctly in advance. Oh, also, you'll need to turn up your volume when it starts.
Chances are your monthly 401k statement will remind you that you've lost a good chunk of your savings. Alan Weir, who turned 60 this month, showed us his latest 401k statement, which he hadn't had the courage to open up.
I'm afraid. You're going to open it now? You want me to? Let's do it.
There's good reason for his trepidation. Nearly half of his life savings have vanished in a matter of months.
It went down again.
How much are you down overall?
Oh, about $140,000.
Do you think you'll ever get it back?
I would probably never see it come back.
Tell me about your 401k.
Does this answer the question?
This is what it was in 2005. 2007, you're down below 2005.
Right. Another one went down almost $40,000. One was
Right.
88,000, and then it went down to like 50.
Based on the video that you just watched, I'm hoping that you can see how an IUL's downside protection can help to balance out your portfolio. So here you have the IUL in green and you have the S&P 500 index in red. And I don't really need to break down this chart for you, right? This is what I call a sixth grade chart, showing you very clearly that if you're going to invest in the stock market, for example, through your 401k or IRAs, index funds, you need at least a 10, 20-year time horizon, because anything can happen. And looking at this chart, just ask yourself, which one would you rather be invested in, the IUL or the S&P 500 index? Again, you shouldn't ditch your 401k, but it's always a good idea to add a product where you can at least lock in some upside market gains. And notice when the market drops here, you're looking at, between 2000 and 2002 and around 2008, 2009. Now, you don't make any money, but you don't lose any money. Again, you're supplementing your overall portfolio, increasing your sleep factor, which I think keeps a lot of people from selling at a time when most people should be buying. And I know it sounds too good to be true, because if it's me on the outside looking in, I would totally agree. How are you able to lock in gains and only get the upside? Well, I can tell you, I think that most agents, even agents with the best intentions, don't really understand how it works. So, since my time is limited for this short video, I'm going to give you granted an oversimplification of how it works, but still, this is the basics of how it works. So the insurance company is taking a small portion of your monthly premium, right? Everyone's monthly premiums. And they're buying options on the S&P 500 index. And don't worry, I won't turn this into a stock options lesson. Just understand that when you buy an option on a stock or an index, specifically what's called a call option, it gives you the right, but not the obligation to buy that stock or index at a specified price before a specified end date. So if the S&P 500 index goes up in any given year and I own call options on that index, how much can I make? The amount is unlimited. And if you've ever traded options, on your confirmation screen, it will show you the max loss and the max gain. Your max gain will literally say unlimited. But here's the best part. The most that you can lose when you buy an option on a stock or an index is the price you pay for an option. Again, that's a 30,000 foot view. There's a lot more to it, but that's essentially how it works. So let me shift gears for a minute and break down why so many high earners and business owners love this product. In fact, IULs are sometimes referred to as the rich person's Roth IRA because there's so many similarities with regard to the favorable tax treatment. Now, couples who have significant incomes, they can't qualify for the Roth IRA. My first mentor in this business, he used to always tell his clients that to win the money game, you have to win two battles: the tax battle and the rate of return battle. Now, we just covered how IULs win the rate of return battle. So let's see how they win the tax battle. Well, money inside the IUL grows tax-free, just like a Roth. Money comes out tax-free, just like a Roth. But where the Roth stops, the IUL takes over and gets even better. Now, unlike Roths, again, there are no income limits with IULs. Doesn't matter how much money you make. Also, there are no low $7,000 or $8,000 max yearly contribution limits. Right? There are $1 million IULs out here. And also, finally, unlike Roths, there are no penalties for withdrawing your money before age 59 and a half. You don't need a qualifying event. Before we jump into the examples, the illustrations, I'd like to briefly discuss the two types of IULs, just to set the stage. And you may hear slightly different terminology, but this is the standard breakdown. So first you have the protection IUL, with a focus on a larger death benefit. And you have the accumulation IUL, with a focus on growing your cash values at a significant rate. In my opinion, just my opinion, if it's not a max funded accumulation IUL, personally, I would avoid this product entirely. And I own a max funded accumulation IUL because if it's a protection IUL, you will pay the insurance company excessive fees. You'll pay the insurance agent a ridiculous overinflated commission, and you could expose yourself to prematurely lapsing the policy down the road. Now, when someone's talking negatively about an IUL, this is typically the type that they're talking about, whether they're aware of it or not. Now, with the max funded accumulation IUL, we reduce the death benefit as low as possible relative to your budget, to your monthly budget, and also the legal guidelines. So less of your monthly payment is going towards the cost of insurance. More money is flowing into your cash value, which means you're building it up again in a much more significant way. But let me give you a few clear examples, illustrations of what both versions look like, and you can choose for yourself. Let's start off with an example of a protection IUL. We'll call this the wrong way to set up this product. Well, if your goal is to grow your cash value at a significant rate. This is just one of the insurance companies I work with. I use multiple A-rated carriers for this product, depending on the client's needs, their budget, any health issues. But this company's software is just laid out in a way that I think is easy for most people to follow. I blocked out the name because I don't want to promote any one company here. Now, in this scenario, the person's 40 years old and the death benefit is $200,000. So now let me break down the numbers for the protection IUL. You see your monthly target premium. I circled the two most important numbers for most people, probably 90% of people who would open an IUL. Your monthly target premium for this example for the protection IUL, $126.87 a month. Just below it, the guideline level premium, $3,747.92. That breaks down to $312.25 per month. So if your goal is max accumulation, that's the number you want to focus on. You can also use the guideline single premium, a little over $55,000 if you like, also TAM or 7-pay. But again, probably 90% of people will only be concerned with the monthly target premium and the amount that they could use to max fund it. So one last thing, if you shift your attention to the language at the bottom, it's extremely important. You cannot go over the guideline level premium and receive favorable tax treatment. If you do, your distributions will be taxed at ordinary income. Even if you say, oops, I made a mistake, I put in too much money, I exceeded this limit, let me just take it back out, that will not work. Once your policy becomes a MEC, it's always a MEC. So whoever you choose to work with, is very important that they understand what's going on behind the scenes when it comes to these policies. I've been talking a lot about the stock market index crediting strategy being tied to the S&P 500. And for this particular company, for this year, you can see a breakdown of what that looks like. They're giving you two choices. You can either have a 1 year point to point with a participation rate, just a fancy way of saying, okay, it's currently 86%. If the S&P 500 went up, I'd say 25% this year, you would receive 86% of that growth. If the S&P 500 went up again 25% this year and you chose the cap strategy, you would be capped out at 15 and a quarter. So that's what you would receive this year. And you're seeing the history. If you look just below, you can see what the S&P 500 has done with both strategies. So you can pretty much evaluate which one you like and then select. And you're not locked in for the life of your policy. You can change from year to year. And there's also a fixed bucket as well that you're not seeing here. If you look at the top, you can see the maximum average crediting rate has been a little over 9%, really good. The minimum 6.87, and that's where you're getting that current maximum illustrated rate. That's the max that I can show you, and that's 8.45 based on the history. So let me jump back to the example of a protection IUL. Again, the wrong way to structure this product, in my opinion, unless the client understands all the risk and still decides to move forward. And also, here's how you can instantly spot a poorly structured IUL. Just notice the first 5 years here. There's little to no money in the cash value. Even if you take the best case scenario on the right, you only have $339 after 5 years. And as bad as this is, I've seen IULs with 7 to 10 plus years of no cash value. Now, even with an accumulation IUL, it's not uncommon for your cash value to build a little slower in the beginning because at the end of the day, it is a life insurance policy. And there's a death benefit, so there's a cost for it. And also the fees for IULs, most insurance products, they tend to be front loaded, but it should never be anything like this. Now let's take this policy all the way up to the maximum amount that you can contribute. Well, in this case, based on the client's age and death benefit of $200,000. We're going to simply focus on the guideline level premium, which is $3,747 a year. Okay, breaks down to $312.32 a month. You could pay that amount every month for the life of the policy, and this would never turn into a modified endowment contract. In other words, you would keep your favorable tax treatment in place. And let's see what this looks like. Oh, also, I know some people, they'll say that with an IUL, the policy could lapse. There's a potential for it to lapse as you're making payments. Well, with most insurance carriers, or every insurance carrier that I've seen offering IULs, if you look below the total premium, you'll see a guaranteed not to lapse before policy year. This is policy year 48. In other words, this IUL would have to go 48 years making a zero return in the stock market. I mean, if we had just 20 years with the zero return in the stock market, it's not going to matter where your money is. It's going to be worthless. You have much bigger problems. Now let's jump to the 5th year with the Max Funded Accumulation IUL. We'll contrast this against the first example, the Protection IUL, where most of your money was going towards the cost of insurance. The agent was getting a super fat commission for that, right? Now you have over $11,000 in the 5th year compared to what, $100? I'm just looking at 6.25. We won't even take it out to the max example. I mean, it's incredible. And that's money that you can access tax-free through a policy loan. And it's very important that you access it through a policy loan. That way, your accumulated values continue to grow as if this money never came out. So let's fast forward 35 years into the policy. Okay, 35 years into the policy, the cash value is over $300,000 conservatively at 6.25. Okay, in the middle. $500,000 based on the highest average return over the past 20 years. Okay, that's the best case scenario. 40 years in, we're close to $800,000. But look at what's happened here. At age 90 to 100, okay, the family stands to inherit over $1 million. And you can see this is a pretty conservative illustration at $300 a month. The rule of thumb for contributions is typically around 10% of your monthly salary. My average client is anywhere between $500 to maybe $1,500 a month. But it really doesn't matter where you start. It could be under $100. The most important thing is getting started, because when it comes to the power of compounding, what Einstein called the 8th wonder of the world, time can either work for you or against you. All right, so that's it for now. I just wanted to give you the broad strokes of an IUL, but if you need a custom illustration for your particular situation, any additional information at all, feel free to click on my Calendly link for a free, no pressure consultation. For IULs or really any other insurance product for that matter, I specialize in mortgage protection, index annuities term as well. So I'm happy to educate, answer any questions. Also, I'm old school. Feel free to just give me a call or text me at 404-721-2980. Again, thanks for watching. I really appreciate your time.